Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick things off here on the SPY daily time frame chart, and then we'll jump on over to the sectors and other intermarket components. What do we see here from a price action and structural perspective? A very clean 4-day balance is in play here. Notice that all of our lows are equal and stacked right at the high of the CPI day last Thursday, and that number is 394.50. The saying goes, the more you knock on the door, the more likely it is someone will open that door eventually, and that would of course result in a SPY daily time frame pullback. But aside from just touching the level back to back 4 times in a row, I would say if we look at the hourly time frame chart, you can certainly start to see a little bit more of a classic head and shoulders pattern starting to unfold here. A breakdown of this neckline easily brings us into the weekly level of interest at 389.50 and the lower edge of the weekly expected range. It also makes sense from a measured move perspective, coming from the head to the neckline, stacking that from the neckline underneath. It's right around this general area as well. If you don't like the head and shoulders, that's fine. You could also just look at it as a very simple descending triangle. Breaking the base of that triangle does the same exact thing and opens up the door for lower. So we are expecting, based on the hourly pattern, a bit of a breakdown of this level on the daily time frame, but this pullback level is certainly interesting, remembering that the daily trend is still up, right? Let's not forget that even if we pull back potentially as deep as the gap close from CPI back here, we're still technically in a daily uptrend offering higher lows. So we've got lows, higher lows, higher lows. Even if we close this gap, which, don't get me wrong, would be a nasty move, it is still technically a higher low here on the daily time frame chart until proven otherwise. That number, the line in the sand, like the must-hold area if the pullback gets extremely nasty, is at 381.25. I don't personally think that the market will go there because that is fairly extended through the weekly expected range lows. However, just keep in mind exactly what happened last week. We breached the expected move high and closed firmly outside of the expected move. Granted, there was a bit more of an important fundamental catalyst there, the CPI gap up. We don't have that type of news into the remainder of this week, so I'm not advocating that we get all the way here, but that is the line in the sand, and it does keep us in a daily uptrend if we reverse off of it. The last supporting piece of evidence for that acting as support is if we take out the fibs from the lows to the new high from Tuesday, right? The updated fib count here would bring the 38.2 in perfect alignment with the closing of the gap, and as long as we're above a 38.2, the market is more bullish than bearish in respect to this overall run right about here. So how are we going to get involved if the pullback does start to take place? It's not like we're just going to buy 389.50 if the market prints a large red-bodied bar like that. That would be silly. However, if the market does something that looks like this, where we get a bit of a hammer candle that undercuts the low and then closes back above that area, 389.50, then great. Now we're looking for a long over that hammer high to rotate back up towards the top of the original 4-day balance range here, as we would call it on the channel, a look below and fail. Right? Target would be 403. So that's one way to play it. You're looking for some sort of buying activity to start taking place around 389.50. And then, of course, the line in the sand area of interest would be the gap close around 381.25. If we were to do something like this, so Thursday's bar might look like this, and then Friday, if we print something that looks like a hammer, then we close, let's say that this is a green hammer, so the close is up here at the highs, that would certainly make a move closer and more comfortable for the options market to the lower edge of the weekly expected move. And early next week, we would possibly look for the break of that hammer high to do something that looks like this. Now, I will concede that sellers are more comfortable underneath 389.50, and although the uptrend is intact, it's definitely more in jeopardy of something that could potentially look like this. For now, a head and shoulders on the daily time frame with shoulder 1, head, shoulder 2. Of course, a breakdown of whatever neckline ultimately forms would start a new daily downtrend, especially after a lower high. So those are the things to consider here. That's the price action. That's the structure that I have in my mind as we move into the remainder of the week. Again, just to keep it very simple, here's a balance range. Something will happen if we break underneath 394.50. If we breach the top at 403, maybe this gap closes overhead, but based on what we saw on the hourly time frame chart, the upward sort of outcome here does not seem as likely as the downward move for some sort of pullback. That's what I've got for you on the SPY daily time frame. Before we go into the internals, I would just remind you that it would also be entirely possible for more balance here, more sideways activity. Remember that we drew this parallel in the weekly watch list video from Sunday. Here's an 8-day balance, right? We're only halfway there if we're going to continue to just go sideways. So it's not like the market can't do this, but these are the levels of interest, 394.50 and 403 on the upside. It does look, as we've just pointed out, more likely than not not that the pullback will be the case into the remainder of the week, but the daily uptrend will remain intact. That's the SPY for you. Let's take a look at our market internals for some supporting evidence. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. From a volume perspective, again, the outflows on today's session were significant, underneath negative 300 million, but so were the inflows on the Tuesday session here from this PPI gap up above 300 million. Overall, they kind of, I don't want to say they exactly cancel each other out, but I would say that this type of activity here is certainly not as concerning as what we saw here ahead of CPI last week, and the outflows would sort of support the idea that, okay, maybe some people are lightening the load, the rally has sort of happened, let's see if we can get some sort of pullback. So this checks out as being reasonable evidence to support that we may break down from the daily balance area. The same thing's going to hold true in the advanced decline line. Very, very mild reads in the negative territory here, a little bit over-correlated on the Tuesday session. So overall, looking for some pullback would not be, out of the ordinary. It's not like we had a way over-correlated down day on today's session, although it was red, right? It's not like we were overly correlated and we're looking for a rebound. This would be healthy for some sort of pullback as well. And the same thing with the cumulative builds down below, bearish, bullish, really, really flat read on today's session. Doesn't really support the idea that there's aggressive buying going on here either. If you want to look at it from the flip side of the coin, right? It's not like anyone's aggressively stepping in here and buying this up at the bottom of the range. So, it would seem more likely than not, let's just go back to the SPY daily, that the internals are showing us that no one's really stepping up here aggressively and buying this. We shouldn't really expect this. And again, a breakdown of the 4 equal lows looks more likely than not based on the evidence that we've seen thus far. So that's what we've got from the internals perspective. What do we know about the market profile? Again, a quick tutorial in the top right-hand corner. If you want to check that out and you don't know what this is, that will have you covered. From a balance perspective, again, very, very useful to look at from a volume distribution. Look, here you go. Notice that both points of control here are towards the lower edge. This one's in the midpoint of the range. You don't really offer much use in the midpoint of a range. That's really where you're not initiating positions. And then we've got one data point up towards the top. So if you want to cancel this one out, 2 of 3 data points are saying that, yes, the market is more comfortable at these lower prices as opposed to up here at these higher prices. And you can certainly see that in the normal distribution that we saw on today's session as well. Not really getting in gear to the upside. The last thing from a volume perspective is the fact that value did build out clean to the downside instead of overlapping, which again is just slightly an indication that sellers are making some progress in the downward direction, or buyers just aren't interested in committing all that much volume up towards the top of that daily range. So that's the market profile. Let's take a look at some sectors now and see what's going on from that perspective. Who was leading, who was losing, and where was the weight today? The XLU for the utilities were up the most, up 8.85%, 85 basis points, and the XLE for the energy sector was down the most, down 1.16% on the day session. Both of those are D for defensive and on a fairly neutral balanced area in here. I'm not going to read into that too much. Let's take a look at the heavier weight sectors though. Of course, the XLK, the heaviest of them all, down 0.6%. The XLF for financials down 0.42%, and XLV for healthcare, third heaviest in our lineup, second by market cap, was down almost 0.3%. All I would encourage you to just remember is that as this move was unfolding in the upward direction here, many of the important and heavyweight names were up north of 1% in the green direction, obviously. And on this pullback, this balance that we've been seeing, it's not like any one sector, barring energy on today's session, is dramatically getting hit. So it's really seeming much more like reasonable rotation as opposed to like outright selling, just based on the numbers that we're seeing. Let's check in on the structure though and see what's going on from this perspective. How are the trends continuing to unfold? Utilities, bullish look here, honestly, with this consolidation towards the highs. The flat top looks much more like a pressure cooker top. Looking for a breakout here is unfortunate because we've got thin structure overhead. So yes, it's a bullish look on the chart, but remember that this is D for defensive. We certainly don't want it leading any sorts of rallies as we're trying to find a new uptrend in the market. So utilities ideally get a fake break and then close back down underneath and do something like this. Whether or not that happens, we'll have to find out, but watch 68.78 in utilities for a possible break to the upside. This thin structure is really what has me most concerned about this defensive sector rallying into the remainder of the week. Next up, XLP is also defensive. And this is looking very similar, honestly, to utilities, with a little balance area forming above this prior flag breakout, so steps in the right direction. If we break this high in here, you could easily see how we could rotate towards 76.40. So again, D for defensive, don't want to see that breakout unfold. The more consolidation we get, the more sideways activity, the better for the XLP. XLY, this is where we do want to see the upward lift, and notice that unfortunately, this also would kind of indicate, hey, we made a good attempt, but we're not out of the woods yet. Notice that this has already broken down down underneath the 2-day balance range here and closed underneath on today's session with an inverted hammer. That upper wick would certainly represent that the buyers did not get any acceptance in the 2-day range, and we are not out of this balance from right around in here. So this chart suggesting a pullback also aligns nicely with the idea that the S&P 500 itself could see some pullback, right? So watch your XLY underneath the low of today's session to kick that off in the SPY. Here's the energy sector, what's going on over here. Certainly looking good up towards these highs, just continuing the slow grind in the upward direction. Going to be pretty difficult for this to really see any meaningful breakdowns until we get underneath 87.50. So quite a ways to go. Ideally, chopping around in here is comfortable, breaking down is comfortable, breaking out to new highs. Not really a good look for your S&P 500. So watch energy. Ideally, the best outcome here is more neutral underneath 93 into the remainder of the week. XLI, what's going on in industrials? As we've been calling for, we're coming into this overhead resistance, and we are starting to slow down. Remember that this really fueled a large chunk of the rally in your S&Ps over the past month or so. So to see this slowing down is like, all right, start to look for the rotation to take place. It's like the XLY has to perk up, the XLK has to perk up, the XLF, XLV have to perk up, and as we've already seen throughout the session today on this video, the XLY doesn't look great. So if this breaks down, if the XLY breaks down, obviously that's a recipe for a pullback in your S&P 500 itself. Let's continue along and take a look at the tech sector now, speaking of, right? And again, this also looking a little bit better than the XLY, but closing right on the lower edge here instead of putting in any sort of meaningful lower wick. 131.50 is your number. Breaking down underneath that brings us to 128, and that is your line in the sand. It's got to hold up above 128, noting that that's kind of the original balance highs. That would be your break, retest, and possible move higher. So if this breaks 131.50, you've got to see it support at 128 here. This is a do or die chart for your S&P 500. 128 must be a line in the sand. I would make some alerts here. I would do something. 128, watch that level like a hawk in your XLK, being the heaviest weighted sector. This will be a driver for the SPY itself. Let's take a look at the XLB. What's going on in materials? Certainly just like the XLI, pulling back off of a known area of resistance. Remember that this too did a significant amount of work for the rally here. Unfortunately, it's such a lightweight sector that it didn't really pull too hard, but structurally speaking, yeah, the chart looks great, obviously. So a little bit of a pullback here would seemingly be welcomed. And of course, we would need to see the picking up of the slack in the XLY, XLK, XLF, XLV, which we'll get into in a moment. Real estate, what's happening over here? Multiple inside bars just consolidating into a little bit of a wedge. Patience is the play. Breakout over the top, breakdown underneath the lows. If we do break down, it's all about the neckline of the inverted head and shoulders, which we know is roughly around 36.85. Remember that this is a lightweight sector, so it's not going to impact what happens in the SPY itself, but remember the wealth effect, right? People will be more comfortable. There will be more discretionary spending if this breaks out to the upside as opposed to the downside, and the housing market goes through another bout of pain. Given the overall macro environment, I would say that the downside is more likely, but who knows? Keep an eye on rates as well. We'll cover the TNX momentarily. Just watch the wedge. Just watch the wedge here and see how it unfolds. Such a lightweight sector, though, as we always point out, it's not going to make a dramatic impact one way or another in your SPY on the day-to-day basis. XLF, what's going on up here? Coming into resistance, right? Coming into resistance, this also has done a lot of work for the rally over the past month or so. So watching for some consolidation up here at the highs certainly would strike me as reasonable at this point in time. As long as we're above 34.50 at this point in time, good to go. We're above the daily 200 SMA. We're pulling back. We're respecting this flag range from right here. So something that looks like this checks out as being bullish for the XLF. I would be concerned about the XLF if we start getting price acceptance underneath that 34.50 level that we had just mentioned right about there. So something that does this into the future, that's your concern for a bearish S&P 500. Anything that's just bobbing around up here, it's neutral, and I would really look for the slack to be picked up again by the XLY and XLK, as we had just pointed out here. Let's take a look at communications. What's going on? It's really all about the rotation at this point in time in the market as we come into this possible top. Here's communications. This is looking better than the XLY, honestly. It did not undercut any of the lows. It's hanging out towards the top. If communications can break out, that will be a bullish force for the market. It just hasn't done it yet, right? So it's not like we've gotten any firm price acceptance above that 50.75, so it's not there yet. It's not there yet. If it does it, yes, positive force for the S&P 500. If it just stays in this range, it's got to be neutral. And of course, then you're just looking to the heavyweight sectors and saying, okay, what are these guys doing right here? If they're all moving lower in sync, this isn't going to save the day being neutral. Let's take a look at the XLV last, but certainly not least, the healthcare sector here, second heaviest weight by market cap. Really interesting look Obviously well above 125, the monthly balance lows. And we've got this balance area, which is just getting absolutely chopped up. We're not really respecting that 133.50 original top of the balance range from right around in here. The new level to break out over would be 134.81. That triggers bullish looks for the S&P 500. But again, look at the daily structure that's unfolded here. Inverted hammer on today's session. Breakdown of this low should bring us here on ultimately a look above and fail here. Something that does that, right? So 130.35 could be in the cards for the XLV, which of course is a bearish look for your S&P 500. Again, who's got to pick up the slack? The XLY and the XLK are the two heavyweight sectors that need to start putting in the work if the market's going to continue the uptrend that it's been on. So that's a pretty in-depth look at our sectors on today's session, because I think, again, the rotations between them right now, risk on, risk off wise, are really, really important for fueling and continuing this rally in the up direction. Here's the ratio grid. There we go. At a loss for words. Top right hand corner's got you covered with a brief tutorial. If you don't know how to set this up, that has you covered. Top four are the risk on sectors. The XLK continues to look better. It's definitely looking better. It's not all the way out of the woods, but we are, at least giving the opportunity for some sort of turnaround now above the 50 SMA. That's the gold line on this chart. You want to see this continue to stay above that line to remain in the more risk on position. XLV getting tangled up here, but overall a pullback and a glaring uptrend. And we saw that it's really more neutral on that daily time frame chart as well from a structural perspective. So I'm not concerned with this. Still strikes me as bullish. Financials look great. And the XLY, this again is where we are struggling. It's got to pick up the slack, right? It was a little bit of a move here, but it's got to continue that and get to that descending 50 SMA, kind of like what the XLK did in this look right here. Until that happens, not really all that put together in the risk on sectors, especially considering that this at best is just kind of a neutral look as of right now. The bottom four are the risk off sectors. Notice that we got a little bit of an uptick in that XLP, a little bit of an uptick in that utilities. Energy is coming in a little bit, even though it's hanging out at those highs, and real estate's kind of sideways overall. Not a great look for turning all of risk off with these upticks that I've just pointed out here in the XLP and XLU specifically. Let's take a look now at our XLY over the XLP. Remember that this represents growth, this represents value. At first, it looked like we were recovering above that 188 level right here quite nicely. We undercut the low from here, which was a bearish and concerning look. And then we recovered a little bit, but look at what's unfolding. We're just getting rejected ultimately at a trend line that would look something like this, right? So as long as we're underneath that trend line, still going to stack up as a bearish data point for the market. And this, of course, noting that we rejected there on today's session, would support more of a pullback look in the S&P 500. So XLY over the XLP is a bearish data point here. Let's take a look at the dollar up next. What's going on with the dollar? So we've clearly broken the dominant support trend line. I'm going to go ahead and get rid of that, and we're not going to cover it going forward anymore. But what's going on from a horizontal levels perspective, you can see a lot of history around this 105 handle in the dollar, and that's where we started to bounce and find a little bit of support. Ideally, for the dollar to remain in a bearish stance here, which would be bullish for equities, right? Remember that relationship. You want to see prices remain underneath 109, right? As long as we're not trading back up into this range here, and we get something that looks like a break, retest, and possibly another leg lower, that will be bullish for equities and support a continued move in the upward direction. If this does bounce, though, into the remainder of the week for the backtest in the first place, remember that that will correlate to a lower move in equities, supporting the idea that, yes, we absolutely could see a pullback in the S&P 500. All it will take in the dollar is breaking out over that hammer high. We make the move here, and that correlates to a breakdown of the four equal lows in the SPY itself. Let's take a look at rates now that we know what's going on with the dollar. Here are interest rates, again, breaking that really dominant support trend line, so we'll go ahead and get rid of that, and continuing to move in the downward direction. This is bullish for equities because we know that lower rates is a good thing for the XLK, the tech sector. It's just not quite all the way in gear yet. So the tech sector's got to take advantage of these rates coming in a little bit. Otherwise, it's not going to mean a whole lot. So continue to monitor this in the downward direction. As of right now, things are looking good. Obviously, a break of that trend line looks good, and we're coming down into this area of support here, much closer to 35. Remember that just correlates to roughly 3.5 in the 10-year rate. So I would watch for continuation into this, and then it's like, okay, what happens when and if we get here? From a narrative perspective from the Fed, let's take a quick look at what's going on with the Fed Watch tool. Notice that there was really no change on today's session in terms of 50 basis points versus 75 basis points for the December meeting. However, what's interesting is if we go out to the February meeting, there was a change on today's session. The market was feeling bullish, pricing in further the fact that the 25 basis point rate hike will be more probable than the 50 basis point rate hike. So right now the market is pricing it as we move forward, a 50 basis point rate hike in December and then a 25 basis point rate hike in February. And that's been reaffirmed by what took place here in the Fed Watch tool. If we take a look at the economic calendar, all of the data points that have been coming in do support the idea that inflation is coming down, but the Fed needs to be careful not to react too soon to this data, right? PPI, which is really more forward-looking than CPI, this is the producer's price index, did come in way better than the forecast to the tune of 0.2 of a percentage point and 0.3 of a percentage point flat on the core reading month over month. In terms of retail sales, this is where the Fed's slightly concerned. Obviously, the demand is still way up, right? So retail sales were way up month over month, and that's not something that the Fed likes to see. So maybe this bearish data point, at least from a narrative perspective overall, could at least help move the market lower into the remainder of the week. We didn't really see that on today's session, but we'll see if the market digests that over the course of the remainder of the week. Nothing really important going on the Thursday session. Some people make the argument that Philly Fed is a red flag event here, but I haven't really seen a big market reaction the past 3 months worth of that release, and then obviously a quiet next week, and things pick up real big for employment into the end of November and early December, right? So that'll be a very important week there. Maybe the market just balances until we start to get this type of information coming out. And I would just remind you that if we go back on over to the SPY chart, again, just to play a little bit of deja vu, this is where we get some balance, right? We're waiting on economic data. This is an economic data release. This is an economic data release. So we might just contract until we get that next catalyst where the Fed will have to make a reaction. And that's where we do something like this or like this. Again, I personally think that it will come sooner than that with a breakdown of the 4 equal lows, but it's just something to consider. Let's get back on over to some special charts on this tab. We'll take a look at the HYG, which is continuing to signal a little bit of divergence. Remember that this roughly represents, let's go with an S for smart money, and the SPX in equities are D for dumb money. You're getting a big higher high here in equities, whereas the HYG in bonds, or the high yield bonds, are not really picking up in the upward direction. So divergence, something to keep an eye on. If this rolls over firmly, that would be your red flag. If this does break out, okay, off the table as a divergence, that is a tongue twister, and we would ultimately get something that more mirrors the SPY. So continue to watch this in the HYG. If this starts pulling in aggressively, okay, that's kind of your signal. Probably looking for the breakdown of the 4-day equal lows there. Let's get into some volatility products now. First up is, of course, the VIX, and this is starting to neutralize and go a little bit sideways. What I think is fascinating about this is the complete shrugging off of what took place on yesterday's session from a more, obviously, European conflict perspective. Of course, there was a little bit of a spike there, but it came right back in, and more importantly, closed back down underneath what was prior support from right around in here. So it doesn't mean that we can't go higher, but it just certainly doesn't seem like anything can phase this market at this point in time. And of course, a lower VIX would be bullish for equities, feeling more comfortable for money managers to allocate funds. Let's take a look at the VVIX, and this too would indicate the same exact thing, even with the big surprise on yesterday afternoon session in terms of the conflict news. This didn't really perk up aggressively. It's not like there was anything crazy intraday that happened. No one was rushing out to buy SPY puts. VIX calls, this never even got anywhere close to 103. This staying down here towards these lows, again, just continues to reaffirm, to me at least, that people are fairly comfortable with this rounded bottom that we've been putting in the S&P 500. Last but not least, from a volatility perspective, is our spread on the forward and back month futures for volatility, and we are still in a very deep contango here. No major concerns. Remember that this simply represents that there is still more risk in the future, meaning that money managers are more happy and willing to allocate capital in today's session. So this is actually a bullish data point. All of the volatility products really are more of a bullish data point for the market. It doesn't mean that they can't spike, but at least as of right now, the market's not really seeing a whole ton of risk. Let's take a look at the remainder of the broad market. The QQQ is up next for our NASDAQ 100. Notice that your balance is not necessarily as clean. We've got some equal lows, but they're a little bit more distributed. And of course, the Friday low is underneath that thick white line here. The concept will remain the same though for the QQQ. Ideally, like this in a perfect world, would stay in a bull flag above 283.50 because this had to play catch up in the first place. It wants to remain outside of the original balance area from here. So again, a very obvious line in the sand would be 283.50. Anything that continues to consolidate here builds the case that, all right, right, maybe we look for the breakout early into next week over 290.50 to finally start tagging the gap from over here. If I just scrunch this up a little bit more, there you go. There's that prior gap, right? So that's the bull case. Breaking down underneath 283.50, a line in the sand is here, right? So this is, if we breach the original line in the sand, then it really can't afford to go any lower than 278.75, which is the lower edge of the weekly expected move and the daily 50 SMA. And that could still constitute some sort of higher low pullback that would look like this. But the risk, obviously, is that we would now have something that looks like a look above and fail. And he closes, like I would really be watching out for a weekly close. If the QQQ weekly chart closes underneath 283.50, that certainly starts to look much more concerning, noting that we would have just this big upper wick. It would look like an inverted hammer, right? We'll see that in just a moment when we get all three charts on the screen from the weekly view, but that's what I've got for you here. So the psychology is very similar. Watch your lows, but your level is at 283.50. Pullbacks can hold at 278.75, but anything underneath that is concerning, especially a weekly close beneath 283.50. If we just stay sideways here, it's probably a patience play into early next week. Let's take a look at IWM, Russell 2000, and the small caps. And here's another bearish data point signaling that a pullback may be due for the market. Remember that IWM has been leading the market rallies. We'll just quickly go over all the data points. It never made the big new lower low, never undercut the June lows here. It was the first to break out. The pullback was very mild to the top of the range. It was the first to make a new aggressive higher high here. But what has unfolded here on the daily time frame chart now is that this one has already broken down underneath the 184.80, which was the low of what you could have considered a very sloppy 3-day balance range from in there, or just this prior high pivot from there. So the breakdown in the IWM underneath 184.80 does strike me as a forward-looking signal to say, hey, maybe your SPY will pull back, maybe your QQQ will pull back. This has been acting as a market leader, and to see it already underneath this area here does strike me as, again, a reasonable thought to say, all right, maybe the market's due for a little bit of cooling off here. Let's take a look at all three of these broad market ETFs back to back. And again, this is a weekly time frame view now. Notice again that if the QQQ closes this inverted hammer underneath the weekly level at 283.50, that's a concerning look. If the SPY pulls back to that weekly level, it's an inverted hammer, don't get me wrong, but it's setting up much more of a 3-bar play with, you know, a little bit of pullback here in the upper third, upper half of the prior week's range. That to me would still be a bullish setup as long as we're above 389.50. In the IWM, you'll notice a much cleaner inverted hammer as well, currently printing underneath this level here at 184.80. Again, more of that bearish divergence that we've been discussing between the three big not sectors, but just intermarket ETF components for the broad market. All right, let's get back on over to our typical setup here, and we'll go through the core list of companies. So Apple is up first. What's going on with Apple? Certainly an interesting looking chart, and I would just watch your lows here at 187.65 daily 50 SMA. If that fails, you're looking for a rotation through this thin structure into 143.50. That's your breakdown, and that would also correlate nicely with a pullback in the SPY itself, noting that Apple is the heaviest weighted component of this SPY. If we were to get a break in Apple up and over 150, okay, now it's game on to the upside. The SPY stays neutral, and you're looking for Apple to make the rotation into 153.15. If we take a look at the hourly chart, you can see this clear as day, right? So technically, yes, you've still got that head and shoulders type pattern. So you're favoring the breakdown of this area here for the pullback in the SPY. That's the base case. But if we do break out over that hammer high here at 150, notice that we've got thin structure from the breakdown, and that should be a reasonably easily achieved target around 153.15. So that's Apple on the daily and the hourly. What's going on in Netflix? Bullish look here, hammer up towards the highs and above the prior pivot from 303. So just treat this as a 2-day balance, right? It's an inside bar technically. So you break the inside bar high, you go bullish, you break the inside bar low, you go bearish. Breaking the inside bar low does strike me as being more concerning, more of a reasonable bearish trade, because we're falling back down into the range, right? This is failed acceptance above, look above and fail. Technically, over time, you could start to target the bottom end of the range here. So one step at a time, but 303 will be your critical level in Netflix, in my estimation, into the remainder of the week. Anything over 311 starts to close the remainder of the gap up towards 332.67, one step at a time. Tesla definitely looking bearish here. If we take a look at the daily, I'll put it front and center for us. Notice that we've got a balance range. We've got a balance range. We've got a look above and fail. We've closed firmly inside now, so looking for that rotation underneath. We did close technically right around 188. Here it is on the hourly time frame chart. You can see clear as day, this is where the most acceptance was. If we start printing under 188 early on in tomorrow's session, I could easily see Tesla continuing in the downward direction through some of this thin structure, right? Even though we've got daily lows stacked up around these areas, notice that they're just lower wicks, indicating their tests. We don't really have a whole lot of acceptance around these areas, so the rotation lower should happen sooner rather than later with the acceptance under 188. Accepting above 188 is really more neutral, and I wouldn't even trust breakouts above 195, again, noting the failure from the Tuesday session. Let's go back to the daily chart, go to Google. What's going on in Google? Google is going to be in a difficult spot to trade. Just like Netflix, it has an inside bar, but notice how extended we are to the upside. I probably wouldn't continue to play with fire on long trades up through the gap. I would prefer, and again, the market rarely gives us what we want, but it would be nice for Google to put in bull flag consolidation that looks something like this, and then we can trade for the remainder of their gap possibly next week. And then, getting bearish once again underneath 96.25, we looked into this original range. If we fall back out of it again, big step in the wrong direction for the bulls, that would certainly trigger more of a short trade underneath the container bar low at 96.25. Next up is Meta. What's going on in Meta? A pretty ugly chart as well. We've got this really, lackluster stair-stepping activity in the upward direction. So it's going to be pretty difficult to pull off a short through that area. There's just lots of overlapping structure. Again, here's the hourly time frame chart. Could you get hung up at this low? Absolutely. This low? Absolutely. Where we found support here? Absolutely. So I'm just not really seeing the clean and obvious short in Meta, although we did print an inverted hammer and we kind of rejected that overhead range from Tuesday on today's session. It's going to make it fairly difficult to pull off longs here. It's just been a very, very odd chart, to be quite honest with you. Through this, gap down range from earnings, they announced layoffs here. We continue to chug in the upwards direction. No price acceptance in Tuesday's range. Underneath this low, pretty difficult to trade through those support areas in here. Just not in love with the structure yet in Meta. Nothing obvious strikes me there on that chart. Here we go with NVIDIA, certainly watching for some pullback underneath the lows, but what do we know about NVIDIA? They reported after the close on today's session, so I am seeing this price action for the first time on stream with you right now. It looks like it was kind of a nothing burger, and NVIDIA honestly went sideways. We're just stuck inside the prior day's range. Okay, so with that being said, obviously this is subject to change by the time 9:30 comes around. We'll, of course, cover it in the pre-market live stream, but as of right now, going to the daily time frame chart, I mean, it looks more likely than not that a breakdown is attractive underneath 158 for some sort of pullback to unfold in NVIDIA. And you're just watching to rotate through this thin structure down towards 148. All right, so about a 10-point move available on the downswing if we get some momentum to pick up early on in tomorrow's trading session after the earnings announcement. If we just stay sideways in the range, that's fine. Let it build out as a flag, then possibly breaking out early next week over 168.50. Microsoft. Up next, what's going on with Softy? A very obvious setup, much more similar to the SPY itself with 3 equal lows all stacked at 240. Breakdowns of 240 get you to the top of the gap at 235.15, then looking for the rotation to close the gap at 228.58. If we just stay sideways, it's status quo. Look for continued chop and balance, and over time, I would start eyeballing the breakout over 250.75 to get towards this gap over here. So more, just like SPY, I would say that the outcomes here would favor a pullback, but if we just go sideways, don't discount it, and over time, 250.75 will be in play. I'm not sure that I would take a break of that on like tomorrow's session. That does seem like a stretch to do something like this. I don't want to be getting involved on that high, right? I'd love to see some sort of better structure to unfold around that for a breakout setup. Next up is Amazon. Last but not least, the mini beast. Really, again, more questions as opposed to answers with an indecisive doji that flushed underneath the 3-day lows. We were watching this setup like a hawk intraday. We talked about it in the Discord. Underneath 97, here's the hourly chart. Look at what took place, right? It was really, really choppy. I suppose it's actually better illustrated on the 5. This is at least where I was kind of getting thrown off, right? So underneath the opening print, lower high, expecting the breakdown. We were accepting underneath 97. It rallies, doesn't really go too far, comes back down, pops above. This one, I will fully admit, chopped me out on today's session. Amazon, I don't like what's going on the daily chart with this indecisive doji. It didn't firmly break down, but it also didn't accept back inside the prior day's range, this 3 sort of day balance right here. So Amazon, I think it's a patience play. Do we accept for a day inside the range? Okay, fine. maybe the next move is higher? Or do we start to get a little bit more of a trend to develop underneath today's low of day? I would watch that. And considering the range is so small and compressed, it would be reasonable to watch for a breakdown of that low and then rotate through this thin structure on the daily to the top of the prior bear flag from right around in here at roughly 91.65. So that's Amazon on the downside. Let's take a look at these three trade ideas now. It's really 3.5. I'll show you why momentarily. But Disney is up first, considering everything that we've discussed so far in today's session. Notice that it looks like we're starting to break down underneath the lows here around 94. So watching for a retracement through the thin structure right back to the breakout point around 90. What does that offer us? Roughly a, let's call it $3.5 range to be trading for on the downside. Looks good to me, especially if we go to that hourly time frame chart. Notice that we have that descending triangle look here, breakdown seemingly imminent with the wearing off of the impressiveness from the buyers here. If it breaks the trend line, that's fine. Wouldn't really want to get involved in a long here until on the daily time frame chart. If this turns into a flag, it's got to crack these highs, right? I suppose just treat it as an even balance. If it cracks the highs, you could close the gap overhead to 98.50-ish. But to me, more likely than not, this is kind of the setup that I'm looking for, especially given what we've discussed in the market so far today. Next up is CSX, which is, of course, a rail. And, what do you see here? Big bearish day there, 3-bar play. 1, 2, and 3, looking for a breakdown of these equal lows to come down into some of this thin structure, right? You could easily come in and close the gap. This was the first one that caught my eye. So looking for a move under 31 to get to 30. That's only offering you about a 1 delta move. It would probably have to act as a swing. This is a slow mover, kind of not the greatest trader. Another one that you could look at is UNP. Union Pacific, and obviously the price point here is a little bit more attractive for us option traders, right? And the structure is just as good. So a breakdown of the 3-bar play, 1, 2, and then 3 that breaks down underneath the inside bar low, closes the gap here towards 205. This is offering obviously much more like a $5 range on the downside, and the options trade slightly better with more volume in UNP. So something to consider there. Last but certainly not least, we've got HD for Home Depot. What's going on with the depot? You can certainly see a clean balance range, but instead of being bearish closing weak on the lows, obviously with earnings, this closed up at the highs. So watching for a possible breakout. Let's go to the hourly chart and grab this level together. What is the number that I would care about? It would be right there around 317. So call it 317 on the breakout. Look left, you're probably looking to target this other high from here around 328, right? So a reasonable move to the upside available in Home Depot, and noting the ranges that like some of these green bars travel from here, here, and here, wouldn't seem unreasonable that we could get there, to the target ultimately over the course of 2 or so days. So either a day trade, swing trade, whatever, looking for some upside in Home Depot. With that being said, it's going to wrap up the midweek market update. If you enjoyed the video or learned anything new today, let me know in the comment section or by giving the video a thumbs up. Don't forget that we will be live tomorrow at 8:30. And with that being said, I wish all of you a green trading week.